Is the market going to crash in 2025? Are tech stocks in a bubble right now? We're going to answer all these questions with some data. I'm Henry Chien. I'm an equity research analyst, CFA chart holder, and now educator for investors. We're all about using data. So I personally think that the US stock market has got another year of gains, but it's going to broaden out. And now let's look through it together so you can decide for yourself. And I'm also going to share a link in the description with the spreadsheet so you can download the different data sets and also look for yourself. Let's jump right in. So when do markets crash? Well, there's 4 characteristics of bear markets throughout history. First is that there's a business cycle downturn. There's a rhythm of history of timing between bull markets and bear markets based on the business cycle. Second is that there's usually extreme valuations that are not supported by corporate earnings. We're going to take a look at that. Third is that there's usually an economic recession or financial crisis. And finally, there's a lot of speculation and FOMO or fear of missing out that ends, and we go from bullish sentiment to very bearish sentiment, so optimistic to negative. We're going to look at all the data sets to see if we're in that kind of situation. So almost every single bear market, you see this, the orange or salmon color lines there, those are times when the markets decline 20%. Every single one of those times has happened during a recession. 2020, 2007, 2001, 94, 87, 80, you get the idea. So those are times when the market declined 20%. There's been 4 other times that where the market has been caused, or the decline has been caused by an extreme valuation in stocks that weren't supported by earnings. 2022, you can't see there, but I would arguably that's also a recession as well. So the reason why this happens is because the US market follows this business cycle. You get a recession 1 or 2 years where there's a contraction in economic activity. And then the rest of the time, about 5 to 6 years, are when the economy is expanding, businesses are growing, people are getting jobs. So the recession is when you have this big corporate earnings decline. That leads to a crash in valuations, and that usually leads to a market decline. And every 10 years or so, you notice we get these big recessions like in 2007, 2020, arguably. Those are when we have like financial crises. So that tends to happen every 10 years or so as well. So how far are we into this current bull market? Where are we in the cycle? Well, from a historical perspective, we can look at it from a time perspective. The last market decline or bear market or mini recession was in 2022. We had that scare of inflation, corporate earnings declined. And since then, it's been about 830 days with this current bull market. Now, that means that time is on our side because the average length of a bull market is about 1,100 days. So assuming that we follow this pattern, we got 200 or 300 more days before we start to think about a real market decline or going into a bear market. What that means is we're just 2 years into this bull market. So these are all the different troughs and peaks over the past 50, 60 years based on the business cycle. If we're 2 years in, the average bull market lasts about 5 or 6 years, it kind of implies that the market is unlikely to crash this year. And that's what we're going to go more into things like valuation and what the economy is actually doing. But just based off timing of the business cycle, it's more likely than not that we're probably just within the middle of the current cycle. And it's going to be maybe 1 or 2 years before we actually see a significant market decline from a contraction in the business cycle. So now let's think about valuation. And basically, are we asking, are stocks really overpriced? Are they overpriced relative to earnings? Here we have the S&P 500 index. We're looking at the aggregate price to earnings ratio. So the PE ratio, that's usually the go-to for measuring valuations, just measures the price of stocks relative to the earnings or the profits of the company. So that's currently at 22, you see on the very right, based on the current earnings estimates for 2025. The historical median is about 17 times, and we have a range of between 13 and 23 times. So we're at the high end of the range. But I wouldn't say that we're at all-time highs yet. The peak in 2001 was about 24 times. So right now, we're not at a cheap level by any means, but I wouldn't say it's extreme or in a bubble territory like we had in 2001. Valuations are not enough for stocks to crash because you can have a market stay at this 18, 20 level for quite some time. On average, a high valuation has lasted between 1 to 2 years. So market crashes don't just happen because of high valuations. We have to start thinking about something else. The other thing to think about is the earnings part. So not just the price to earnings ratio, but what are the actual corporate earnings of the S&P 500 companies? And one of the reasons why valuations move up, it's not just because stocks are getting more expensive, it's because the long-term growth of these companies have been picking up. Here we see the price to earnings ratio, that's the red line. You can see that's been going up, but the blue line is the long-term expected earnings growth of these companies, and that's been going up as well. So the real question when you think about valuation is not, are we at a high price? Is this valuation high enough, or is this valuation being justified by the actual earnings growth of the companies? In 2000s on the left, we had that market crash because the earnings growth of the companies went from 18 to all the way down to 12% in terms of long-term earnings growth. And that's what caused that decline and market crash from the decline in valuation. And the other thing that we need to think about right now is that if we look deeper, it's actually both the largest companies, the Magnificent Seven, the companies like Google, Facebook, Amazon, Meta. Those are the companies that are actually growing both the fastest and also have pretty high valuation. The valuations for these stocks are closer to 30 times, but their expected growth is also pretty high as well in the 20-25% range. And the reason why it's pulling everything up is because the Magnificent Seven stocks are also a big chunk of the market right now. They represent about 35% of the S&P 500 market capitalization. So when we start thinking about whether stocks are in a bubble, we are actually starting to think about whether or not these companies are in a bubble, especially these like AI companies like NVIDIA, because we've heard so much about this AI boom. So the question is, are we in a bubble? Specifically, I think, are we in a bubble in AI? Now, I was looking back at some of the history of bubbles. This is from John Kenneth Galbraith. He studied a number of historical crashes globally. There's usually a couple common characteristics of these bubbles. First is that there's something new. We had junk bonds in the 80s, mortgage debt products back before the financial crisis with the housing boom. So there's usually something new, some sort of new financial instrument. And then there's also a ton of leverage. So people borrowing to buy up these assets. People were borrowing a ton of money to buy houses before the financial crisis. And so you get a lot of speculative buying. And, that speculative buying pushes up the price until it obviously stops because it's not supported by the underlying earnings of the things that you're buying. And so then that crashes, and that's where you get the pop in the bubble. So the question is AI a bubble? Well, let's think about this from the numbers of what's actually going on. So when we start to think about AI as a new thing, it's definitely a new thing, right? And that's what's driving a lot of spending for these companies because they think AI is going to be a new growth driver for the economy. They're called the hyperscalers, so companies like Alphabet, Amazon, Meta, Microsoft, right? They're spending a lot of money on chips to build data centers in order to power these AI models, right? So it's certainly a new thing, and now it's just a question of whether or not AI is actually going to really add value to the overall economy. But if we look from the other criteria of whether or not there's things like leverage, are companies borrowing money to buy up chips? Well, that's not exactly true. If we look over here on the left, you see this is CapEx. We have capital spending. Most of it's going into this. The boom, at least, has been going into AI data centers. They're not borrowing money to spend on these chips. What they're doing is they're spending a lot of their cash flow. They're not spending 100%. You see on the right, they're actually spending about 40, 50% or so buying chips. It's not like they're borrowing money. A lot of these companies make a ton of cash. So what they're doing is they're using their cash to buy chips. So there's not really much leverage involved. And what they're doing is they're using it to build out different production of things that'll power AI. So that's the chart on the right. We see computer equipment, semiconductors, basically data centers. And so they're using these chips to build data centers. And then the question is whether or not they're actually going to make money from it because they're using software from it, making software from it. Now, I know it kind of feels like a bubble because everyone's talking about it, but I don't think it's a bubble if we actually look at what's actually going on when it comes to money with AI. So the problem that when people were speculating on things like tulips or houses is that the houses and the tulips weren't actually making any money. But when we look over here, first we see, I'm looking at the analyst estimates, so that the sales and earnings of these two major companies. And when we look at the chip makers, NVIDIA is clearly making a lot of money selling chips, right? So they've grown at 130% last year. They're expected to grow 50%. And where that's coming from is if you've heard news reports from like Meta or Microsoft, they're throwing out crazy numbers about how much they're going to actually invest, right? 60 to 80 billion. And so when it comes to actual spending on chips, like these numbers are clearly justified. Just 60 billion would represent that growth in the fiscal 2026 numbers for NVIDIA alone, or that represents this year's expected revenues. So there's clearly a lot of money that's going into buying these chips. So I think these numbers in terms of the expected growth for NVIDIA are very justified. If we want to look beyond 2027 and onwards, right, that's its own debate. But so far, I think they're justified. And then when we think about the people actually buying those chips, so companies like Microsoft, they're investing in those chips. And what they're doing is they're using it to build cloud software services, right? They're offering their cloud to other companies. They're making their own AI tools. And what has been happening is they're actually making money off of it. It's boosting their revenues. Cloud services are growing about 20% every year. And so when I look at estimates for Microsoft on the bottom in terms of their sales and earnings growth, you can see that they're growing at between 15 to 20%. I think that's reasonable given that cloud has been growing at 20% or so. If companies are making money from selling AI software using these chips, I think it makes sense that it justifies the valuation. Question, of course, if you've been hearing about things like this DeepSeek model, which shows that there could be a really lower cost for building AI models, a real question for investors is whether or not Microsoft can continue to make a lot of profits from AI. But so far, I wouldn't necessarily consider it a bubble in any sense. Now, but with all that said, when we look into the actual stocks in the S&P, there's definitely stocks that are very, very expensive and overvalued. FICO, amazing company. They do like credit checks. If you ever get a credit card or mortgage in the US, you get a FICO score. This company is trading at close to 80 times price to earnings ratio. So that's a crazy valuation in any type of environment, right? Like if you bought that company, it's going to take you 80 years just to get paid back in terms of its earning if it just stayed flat. So 80 times is a really high value. But the thing is that the market has been revaluing. It's coming down. It's close to 62 times PE. And so the market is almost normalizing already. The valuations are coming down. So I don't think we're in a bubble territory yet. If anything, I think that valuations are probably going to come down, but it's not like every stock out there is so highly valued that it's going to lead to a market crash because these companies aren't making earnings. Most of those companies that we covered that have high valuations are growing quite well. So what I think could actually happen is in the S&P 500, we have a small chunk of companies that dominate the market right now that have really high valuations. That's the Magnificent Seven, so on the top. And we have the other companies, X the Magnificent Seven on the bottom over here. And so those companies are trading at lower valuations, right? And they're not at peak valuations if we look at the 2021, 2022 numbers as peak just yet. So I would expect what could actually happen is valuations for really expensive stocks might come down, especially as their growth slows down or decelerates. And maybe it starts to shift to other companies in the S&P 500 and growth and valuations will start to normalize. You could have like the top 10 or top 12 tech or AI stocks, their earnings per share growth might start to decelerate. And then that would lead to valuations coming down. And then the rest of the S&P 500, their earnings per share, because they're still growing, they might even accelerate a little bit. So you would have this broadening out of the market. Some stock valuations would come down. They would just underperform or just wouldn't have as strong as returns, but they would still grow with their earnings. And then the other stocks would start to have improved earnings and their stocks would come up. So it's like broadening out. There's not a market crash, but instead it's sort of like some come down, some come up, and we start to see more of a normalization of extreme valuations coming down and other companies' valuations coming up. So honestly, what I think is a better way to think about valuation is something called the equity risk premium. So instead of looking at just the price to earnings ratio, we look deeper into what is the expected return that we're getting from stocks. That allows us to compare it with different types of assets. So the equity risk premium, how it's constructed is first we think about what's the expected total market return from stocks based on the expected dividends and buybacks that we're expecting to get from the companies in the future. So we're taking into account both earnings growth and working out a return based on the value of dividends and buybacks that we receive as investors. So then we can calculate what's called the equity risk premium by taking that expected total market return and minusing the current risk-free rate. So that would most likely be the US Treasury rate as a government risk-free bond rate. And we get that premium, which would represent the additional return that's being implied by the price for taking equity risk or the risk of buying the stock market as a whole. So when we look at the overall equity risk premium for the US equity market, currently it's about 4.18, depending on how you calculate it. So this is from Damodaran, a professor from NYU. So historically, the equity risk premium has basically traded between 4 to 6%, implying you get 4 to 6% return above the risk-free rate. So right now we have about 4.18. So that would imply we're getting 4.18 above, in terms of returns, above the 4.65 current US 10-year Treasury rate. So we're definitely at the low end of the 4% range. So that lower risk premium implies a higher valuation and higher prices. But again, that's not super crazy because if we look historically, if you want to think about real bubble territory, like in 2000s or before the tech bubble, we got to an equity risk premium of below 3, which is crazy. Yes, I think we're at a high valuation, but even when we're looking more rigorously at the returns that we're going to expect, it's not necessarily a bubble. And another thing to just keep in mind is the risk premium can stay at this low end at this 4% level for a while, right? Remember when we talked about high PE ratios, high valuations can last up to 1 or 2 years. So there isn't any reason for valuations to come down just because they're really high. So until we get that reason, the market typically doesn't sell off. Because the market tends to be in a bull market most of the time, it also makes it a little bit harder to time things based on valuation alone. And the funny thing is, right, like if we're looking at investing at all-time highs right now, so all-time highs in terms of price and not valuation. So this is from JP Morgan. I love this data set because it's showing that if you bought the S&P 500 at an all-time price high versus at investing in any other day, so that would be the chart on the right, you can see that when you look out for the next 2 to 5 years, which is, I'm assuming most people are investing more than 2 to 3 years, you get a higher return than if you bought it at any other price. So statistically from history, because the market tends to be at a bull market majority of the time, even if we're at all-time price highs, it's actually better to keep buying. And so that's why you use things like dollar cost averaging if you're buying an index of just buying over time and not really trying to time the market, even when valuations seem high. So if we're looking at it from a valuation perspective, I think we're okay. From a cycle perspective, I think we're just 2 years into this current bull market. So we have some time to play that out. What we really want to think about then is recession risks, because that would both cut short a cycle as well as lead to a decline in valuation. That would usually be the trigger, some kind of recession that would lead to a market crash. So what happens in a recession, now we're looking at the past 30 years or so, what happens in a recession is earnings go down. The blue line goes down during recessions, which would be the gray bars over here. If you imagine that 2022, it wasn't technically a recession, but that was when also GDP contracted, you see that dip in the blue line or earnings for the S&P 500 companies as well. They're making less money during a recession. And so then that drives the market lower, it lowers valuation. And so then that's why recessions really are the biggest risk when it comes to thinking about a market crash. And we need to understand that recessions cause declines because it's associated with a decline in GDP. So the red line over here is nominal GDP, and GDP is just gross domestic product, which represents the total value of products and services produced by the economy. Earnings growth for companies tend to follow, at least directionally in terms of growth, nominal GDP growth. Now, when I say nominal, I'm just talking about real GDP growth. So that would be the value of the products and services produced, normalized for any price changes, adding on the inflation, which would represent the price adjustment for the value of these products and services. Long-winded way of saying is that companies are the ones making products and services, usually in the US economy. And so that's why when we're thinking about recession risk, we want to start to think about as a whole, whether or not that there's a risk for a contraction in GDP, meaning less products and services being produced. So that's why when we're looking at GDP, this is from the past 7 years or so, you can see in 2022, we got that little contraction. Obviously, a big contraction in 2020 with the COVID crisis. And so those are obviously associated with the big market decline. What we really want to understand is whether or not that GDP can continue to grow at a positive rate. So right now, the current forecast is 3% for 4Q. If we look at Goldman's estimates for real GDP growth for the next year or so, we're looking at a real GDP growth of about 2.5%, 2.5%. So these are Wall Street estimates. Obviously, they can change, but if things all go to plan, then it's unlikely a market will crash because we have GDP growth and we need a recession or contraction in GDP growth for company earnings to decline and for the markets to crash. So based on that as a foundation, we want to start to understand the assumptions for that forecast for GDP growth in order to understand whether or not there's a risk of recession coming, and we're going to look at it from what's going on in the actual data. There's two ways to look at a recession from the GDP perspective. We can look at it from the supply side, so the people producing the goods and services, as well as the demand side, the spending on these goods and services. So let's start off with the supply side. This is actually super simple to think about. GDP, when it comes to the total value of products and services being produced, you can think about it as a function of a number of people in the economy working and producing stuff, and the value of those products and services that are being produced by those workers. So we first start off with labor supply. We need to have more people working in order to have more production and more economic activity. That tends to drive GDP growth and drive earnings, and that's what makes the market go up. So when we're looking at trends for labor supply, we're looking for a risk of whether or not there's going to be contraction in the number of people. So the first thing on the left, we're looking at payroll numbers that would represent more people working. That's been positive since 2021. So that's a good sign. It means that there's more people with jobs producing goods and services in the economy, which will drive earnings in the market higher. The other thing to think about from a longer term perspective, on the top right, we have the Congressional Budget Office, the forecast for population growth, combination of immigration plus net population growth from births and deaths. And so we are putting those things together where we have labor market growth of growing between 0.5 and 0.8. And another thing on the bottom right is labor force participation. Basically, this chart just showing the trend of whether or not working age population, between 25 and 54, the number of people that are participating in the economy is also growing. So long-winded way of saying is that there's going to be a growth in labor supply. And that's what we want to look out for as a risk, is whether or not labor supply is declining. So far from a supply perspective, that looks fine. But what's more important from a supply perspective is we want to see that workers, when they're working, are actually having a productivity growth. So productivity is just a growth in the output or the GDP per worker or labor. And the reason why U.S. markets and U.S. economy has been so strong is because productivity has been improving since 2022. Now, why is productivity so important? Because productivity means that the labor supply is producing more goods and services. That leads to more earnings and revenues for companies, and that leads to the market going up. So when we see a contraction in productivity, that's a risk. Now, the good thing is for the past couple of years, since 2022, productivity has actually been improving over the past few years. I think a lot of people have actually been trying to figure out why it's a new trend, but I think it's pretty simple to think about, especially if you work around people who have a lot of tech kind of stuff. It's become a lot easier to produce and make things with technology, right? You can use software to automate a bunch of tasks. It's much easier to communicate. You can distribute and sell things online, just a lot of examples. So I think productivity is starting to see that boost from technology, and that might continue. So when we have productivity at 2.3, that should give us confidence that we can continue to have GDP growth. Just to kind of put these numbers together, we have 0.5 to 0.8 population growth, assuming that's correct. Then we add on that 2.5 productivity growth. That's how we get that 2.5 type growth estimates. And so the key thing that we want to pay attention to, we just want to make sure productivity doesn't go down. And there's one key risk that could happen, and that's inflation. So we already saw that. And maybe it's a little biased because that was a clear risk, and so sort of in the front of mind. But really what happened in 2022 and 2023 is we had this crazy spike of inflation, right? This is a PCE, so Personal Consumption Expenditures Index, right? This is used by the Fed instead of the CPI, but they're representing the same thing. From like a real perspective, like prices were going up like 10%, which sucks. But that's what caused the bear market, because it sucks to have prices going up as a consumer, but it's also really bad for the economy as well. Because it raises costs for everything. And you're going to see exactly why in the next few slides. But thankfully, just from an overall perspective, that's been coming down. So the risk has been easing, and hopefully we get closer to that 2% target rate. But right now it's about 2.4. Now, why is inflation such a risk? Is because higher prices basically hurt everyone. As a consumer, higher prices makes it harder to afford things that you need to buy, right? And so it's the same thing with companies. When unit labor costs go up because you have to pay workers to offset that inflation, it really impacts your earnings as well. So unit labor costs go up, inflation goes up. Unit labor costs basically represents your cost for the time relative to the output that you're producing or the productivity of workers. So when that goes down, it's not great. So just to illustrate what that looks like, so this is what happened in 2022 when we had that inflation. So you see that brown dotted line over there on the top, you see the big spike in unit labor costs, so 7%, right? So cost of labor had to go up in order to compensate for that general increase in prices. Now, the problem is that doesn't actually lead to an increase in output. So output was much lower than the unit labor costs. And then that leads to lower profit margins for companies. And so then that's what causes a decline in earnings, and that's what created that decline in the market prices. What we do want to see, which thankfully we did see shortly after 2022, is instead of inflation, we saw inflation come down and we saw later productivity pick up. So that means that labor or workers were starting to improve their output. Unit labor costs were now below productivity. So now workers are both producing more value. That leads to better margins for companies, better earnings for companies. And also, like, it also improves pay for workers, like real pay. So pay after the adjusting for cost of inflation. So that's the ideal situation. And so as long as we keep that going, and so far it doesn't seem any risk to that because inflation is coming down. But the key thing is that productivity is what's driving the growth in earnings and driving the growth of the market. So just to put that all together, we need inflation to come down and we want productivity to stay at that level. Because if we don't, that's why you see in the right side of the chart, you see that decline in profit margins. You can see that that was basically caused by that spike in inflation. And that's what caused earnings to go down. That's what caused the value of stocks to go down. And so really what we're looking at is the risk that productivity goes down. The biggest risk to that is inflation. So thankfully, inflation is coming down, productivity is going up. But let's look into the actual drivers of inflation to see whether or not that's still a risk. So first off is the price of oil. Now, oil is important because it's such a key energy input, right? Oil is still a big source of energy throughout the world, and energy is used to create products and services. So when the cost of energy goes up, if it goes up a lot, it raises the cost of everything. So that's why there was so much inflation in 2022. You can see in the chart on the right over there, a huge increase in the oil price in 2022 is really what started to kick off that trend of inflation and prices going up. Now, thankfully, that's come down. And the way that we start to think about oil prices is just a balance between the production of oil versus demand of oil, right? If there's more demand than production, price goes up. So thankfully, if we look at the comparison between production and consumption, it's basically balanced right now. If anything, OPEC, so the Organization of Petroleum Exporting Countries, like Saudi Arabia, they've been cutting production in order to keep prices at this level. So they don't want the oil price to go down. But right now, oil prices seem stable. If they're cutting, that means that we are not in a situation of a lack of supply. So that reduces the chance of an oil price spiking. So that tells me that costs from oil and energy perspective should stay relatively stable. So that reduces the risk of inflation. Second reason for the inflation spike, now again, this might be a little bit biased because this is what happened a couple of years ago, was after the 2020 pandemic, there was this huge spike in government spending. So over here on the top, we have total spending, we have non-discretionary spending, and then we have discretionary spending, the green line on the bottom. You see this huge spike after the pandemic. So what happened is because we had this shortage of goods during the pandemic, because supply chains were cut, demand was cut, we had then put on the higher oil and commodity prices, and then you throw on top a bunch of stimulus spending. The government was distributing a lot of cash. There was government spending programs. That made prices go up even more. So thankfully, that seems to have passed as well. The Trump administration is the Department of Government Efficiency. They're looking to cut costs. So there hopefully isn't going to be any new programs. They're going to add in a ton of stimulus to the U.S. economy because that could create inflation. So that should ease that risk as well. So just to put that all together, because inflation is such a risk, that's why I'm spending so much time on it. I think the risk of an inflation stock is still going down. This is from KKR. Their forecast is for inflation to stay sticky at about 3%. So it's probably higher than what most people like, but at least it's stable. So I think that eases inflation as a risk for a market crash. And then the assumption here is that if we can keep productivity improvements at this 2.5 range, currently unit labor costs at about 2.2%. So you can see that if productivity is higher than unit labor costs, that's what's going to allow companies to expand their profit margins. If companies can expand their profit margins, that's how they can grow earnings at that 11, 13%, so faster than that 2.5 or 5% nominal GDP growth, right? 2.5 is real GDP plus 2.5 for inflation. So that would represent the sales of companies. So this is making sure that the S&P 500 earnings growth is in that 11 to 13% range. That's what drives market prices up. And again, we're looking at the risk of earnings going down. So we're focusing a lot on inflation because inflation would create profit margins to decline, and that would lead to a decline in earnings. So to put that all together, the key that we're looking for here is for the increase in productivity to continue. We stay at that 2.5 range. That's the key for companies making earnings. And the risk right now, that's what I see, is just inflation. That would take down margins again, but I think that risk is easy. If I really had to put a number, I would say the probability is like 10, 20%. That could lead to a crash, but it seems quite low. I would think about is just any potential risk to labor supply or productivity. It doesn't seem to be increasing so far. So I would put the chance of a supply side driven recession as quite low. Okay, so now let's look at the recession risk from the demand side. So now we're thinking about the spending on goods and services. So we got supply, now we got demand. Now, when we look into GDP growth from a demand perspective, we can start to see where all this spending is coming from. And it's basically two areas right now. So if you look over here, this is the components of real GDP growth. The blue line, which is the thickest over the past couple of years, has been consumer spending. And the U.S. economy is basically, about 60-70% of spending is related to consumer spending. So 2.5% of that 3% current real GDP growth is coming from consumer spending. The other bit right now, which is the green bar over there, it's a little smaller, but that's super important because that's investments. Investments have been a key driver of GDP growth and arguably, I think, productivity since the beginning of late 2022 and early 2023. 0.8% of GDP growth is coming from investing, and that could be things like investing in equipment, right? So AI or spending in manufacturing and so forth. And so now let's think about the drivers and the risk to that spending to see if there's any signs of a recession of spending coming down. So from a consumer spending perspective, the biggest risk, and it's always been the case for the past 20, 30 years or so, is unemployment. If unemployment goes up, that means there's less people working, less spending. That leads to companies cutting workers because there's less demand. They make less earnings. That creates a recession. That leads to a market crash. So when we want to look for the risk of unemployment rising, we're just looking at the data every time it's released each month, and we can see that it's gone up a little bit. That's why there is this risk of a recession. But it's been stabilizing at that 4% level right now, which I think is honestly a good level because it means that unemployment can go down to that 3.6 level like we did right before 2020. So that means there's room for hiring. So that's just from a supply side perspective. 4% is not super low and it's not super high, but I think it's okay for now because when I look at job growth indicators, first thing I always look at job openings. And so that's been going down as well since 2022. You can see that basically corresponded to that kind of mini recession we had in 2022. That also seems stabilizing. So as long as there's demand for workers, the assumption here is companies will keep hiring workers and that'll allow more consumer spending. Now we're going to get into what's companies investing in a second. But the key thing that I'm looking at here is that job openings rates are stable. They've gone down a little bit, but it looks like they're recovering or at least being stable. So I think from a demand perspective, from consumer spending, I think we're looking okay as long as we keep getting jobs growth. So that's a key thing to look at. And we've been seeing that over the past couple of months. No indication there's going to be a big round of layoffs across the economy. So I think we're good there. Second thing is if we're looking from a consumer perspective, even if people have jobs, they need to have money to spend. So that's why we look at the consumer finances. So when we're looking at the balance sheet, it looks pretty healthy. You see on the left, the consumers as a whole have much more assets versus liabilities. If you look at the top right, you can look at the debt service ratio. So when consumers were levering up to buy houses before the financial crisis in 2007, you could see that debt payments were almost 16% of personal income. Now we're at a more normal 11%, which has been pretty low. So that's great. That means consumers are not borrowing too much to buy stuff, basically. Delinquencies have been going up. So that's on the bottom right. So that just represents if you're paying your loans back late. So that's been going up. And again, that's showing that we had that kind of mini recession 2022, 2023, right? There's been a bunch of layoffs. But as a whole, it looks like things are fairly stable. It doesn't look like we're about to enter a recession. If anything, it looks like the consumer is pretty healthy in order to be able to keep spending. And so that's good for the GDP consumer spending side, and that would drive growth for a lot of companies. So I don't think there's a ton of risk here, as long as jobs growth continues. Now, from an investment perspective, so now we're looking at the companies investing. That's the other key part of GDP growth. Really, we want to make sure that there's continued opportunities for companies to keep investing. And so AI, that would be the red over here. It's a small chunk, but you can see that's been a big driver of investment spending. So I think that's going to continue. There's still a lot of incentives from the government for companies to invest. This sort of dark blue line, that's equipment related to the IRA, so that's the Inflation Reduction Act. There's a ton of incentives right now from the government for companies to invest in the US, so things like factories, semiconductors, what have you. There's a lot of momentum to encourage companies to invest and build stuff in the US. And there's also expected, at least, demand for companies to invest in houses as well. There seems to be a lack of housing supply. So that's why we also have forecasts of the bright green over there for structures, which represent forecasts for investing in houses. So putting that all together, assuming these forecasts are correct, right? And this comes from Goldman. Basically, it's assuming that over the next year or so, we have CapEx, which represent the dollar amount of spending for companies, is expected to grow at 5%. That would indicate that we still have growth from the investing side, which would support the demand side of GDP growth. So that would just means that companies are continuing to invest in the US, which would drive GDP spending as well. Now, what I do like to track, just to make sure that these type of forecasts are correct, is corporate issuance. Now, what that is when companies, typically when they invest, they need to raise money. So a lot of times they'll sell corporate bonds to finance their projects. And so here we can see the, if you're looking at non-financials numbers, so that dark green number over here, that represents the dollar amount of companies that are selling corporate bonds, so raising money by selling bonds and borrowing from investors. You can see that's been going up a lot. You can see that in 2022, when we had the contraction, that's why we also had a contraction in investment spending. So companies are borrowing less. That's been growing since then. It grew a ton over the past few years. And the forecast for 2025, this is from S&P Global. So it's a big rating agency. They really pay attention, obviously, because that's their business, to corporate issuance. They're expecting about 4% growth on the overall growth of corporate financing or companies raising money for debt. So that is what's helping support the investment side of GDP growth. You can think of it like this is how they're getting money to invest in the US. And that would support growth in GDP. It supports sales and earnings, right? If a company is starting to build new factories, that supports whoever companies are making the stuff that they're investing in, right? So that's the spending side. I don't think that there's a key risk for a decline in investment spending. I think, again, that would be inflation or recession. And obviously, recession is caused by investment spending declining as well. But I don't think that there's any signs that that's happening. The final thing to check, when we're looking at both the consumer side, so people, as well as corporations, remember when I talked about some of the biggest risks from a bear market perspective is a financial crisis. A financial crisis is caused when people borrow too much. So they take on too much debt. So we can look at leverage, so just the amount of debt in the US economy for both businesses as well as households as a percentage of GDP. You can see in 2007, that's why we had such a financial crisis. That went up to a crazy amount of debt, right? Like basically they bought a bunch of houses, the houses stopped making money, you have a ton of debt, they have to sell their houses to pay off the debt, causes a crash, and everyone has to pay down their debt, and that's basically what causes a recession, right? The deleveraging, people paying down debt. So right now, it looks like we've already been deleveraging. So companies are borrowing less relative to GDP. That's been going down. So that's a really, really good sign that we're not having any type of environment that would create a financial crisis. So I'm not really worried about that as well. It looks like the financial state of both consumers and businesses are looking really good. So when we put that all together, so I know that was a lot, but we looked at the supply side, demand side GDP. Both the supply and demand side look good. There's forecasts for growth for both. I don't think that there's a sign of recession. If anything, it looks like, because we came off a mini recession, we're actually going into what's called early cycle. So if we tie that all back together in terms of a business cycle, usually what happens is you have this recession, then you go into early cycle, mid cycle, late cycle, right? The market, from a timing perspective, suggests we're mid-cycle. Because we're coming off a recession, I would say we're kind of early cycle as well. You can probably tell that I'm quite optimistic based on these indicators. But the thing is about early cycle is that means that is usually a positive environment. It means companies are growing again, and that's usually good for stock prices. Obviously, it's offset by the fact that there's high valuations, but I think overall, from a recession risk standpoint, very, very low risk of recession this year. So the other final part of when we're looking for a market crash is we want to see some pretty extreme sentiment. Really what happens is before a market crashes is you have a ton of speculation. People buying stocks thinking there's a lot of FOMO or fear of missing out. So there's a huge amount of bullish sentiment, and then all of a sudden it drops because the market prices are not supported by real earnings, and then sentiment drops. So we're looking for extreme sentiment right now. So the funny thing is, because I've been looking at hedges or ways to protect just to prepare for maybe a market crash, I like to look at the prices of options. So this is the VIX index. This is the price of options. And so it tells you two things. One thing it tells you is the cost of buying an option. So, for example, I was looking to maybe buying a put option at some point just as a preparation in case we had a market crash. So that would be the right to sell a stock. The VIX would kind of show you the overall level of option prices. Now, what the VIX also indicates is that because option prices reflect the expected volatility of the market, when expected volatility goes up, that means that option prices go up. So when the VIX goes up, that means that there's a higher forecast of volatility for the next 30 days. Now, right now, we're at about a 15% level, which is quite low. So that just indicates the market expects, not a lot of volatility. And volatility is tend to be associated with market crashes. So if you look in early 2022, we're looking at a VIX of about 30, 35 times. That's when we were really entering like a market crash. So just from the VIX alone, we're not at the level of a market crash type of environment, which would kind of be like 25, 30 type of VIX range. But if we want to look into the cost of protection, there's something that you probably want to look at. It's called the skew index. So this is basically the cost of buying hedging or protection for a portfolio. It basically measures the ratio of a cost of buying a put, which is a right to sell, versus the cost of buying an option or call option or right to buy. So when the skew index goes up, it just means that there's a lot more people buying protection, and so the cost of buying protection goes up. So this can measure and give us an indicator of based on price of how much people are willing to pay for protection. Right now, it's pretty high. So it's really expensive to hedge a decline with options right now. I calculated very roughly a couple of weeks ago that it costs like 3 to 4% to hedge a 10% decline over the next couple of months. So what that tells you is that investors are concerned out there. They're buying protection and that there is a sense of risk in the market. You can also see that from the bear sentiment perspective. So this is from the AAII. This is the American Association of Individual Investors. They just do a survey just to ask how people are feeling about the market. And so right now, the red is whether or not people are feeling bearish, so they're worried about the market. That is, for in the past couple of weeks, has still been much higher than the historical average, about 30% or so. So that means that people are concerned, people are bearish, people are worried about a crash. And so what that does is I think that just makes the market kind of skittish, right? That's why you might have more volatility this year, more ups and downs, because people are thinking about valuation. So people are worried, they might overreact. But from a real market risk standpoint, from a behavioral psychology perspective, it's actually safer when people are bearish because the risks of the market are more likely to be priced in. That makes it less likely to crash. Crashes usually are preceded by environments where there's very, very little bearishness. When there's so much bullishness, so many people are expecting stocks to go up, that's usually the sort of seeds for a market crash. So when I see bearish sentiment, it makes me less worried about a market crash. But from a positioning perspective, we want to think about the actual dollars. So again, AAII, the American Association of Individual Investors, one thing that they also do measure is how much cash allocation people have. So the basic idea here is that if cash allocations get really, really low, that's like people voting with their dollars that they're all in on stocks, right? And so then that is a risk because that means that if everyone's put there's going to be less people buying. And so then that creates more of a scenario that if people stop buying, stocks can start crashing, right? If there's some sort of catalyst of a recession or something like that. So right now we're about 15%. You can see that it was at close to like 10% or so right before the 2022 market decline. We're not at those levels yet. It's come down. So we're obviously getting close to potentially a market decline when everyone has gone basically all in on stocks, but we haven't reached that point yet. So I don't think that this indicates either that we're screaming risk of market crash because people are too speculative in the markets. I think we're getting close, but we're not there yet, at least for this year. Now, how can you prepare? Obviously, we do want to prepare for market crashes. There's a couple of things you can do. First is you can buy put options. So that's just buying a put that gives you the right to sell at a certain level. That value will offset any decline from your stock prices, but you have to pay for it. It can be expensive. You can also buy outright VIX futures. So you know that volatility goes up during market declines. So you can buy the actual VIX using futures or buy a VIX ETF like VXX. But you got to be careful with VIX futures. If you do buy it or VIX ETFs, you can't hold them for too long because you also have to pay a cost that, generally speaking, when you're holding VIX futures, the value would decline because there's a premium in buying volatility. Final thing is you can just short S&P 500 futures. That would neutralize your market exposure to the S&P 500 index. Now, these are all things that if you're actively investing, actively picking stocks. So I only have been looking at that because I buy S&P 500 futures and I combine the futures while picking stocks. So I get extra returns so I can keep having my S&P 500 index return and pick stocks. But obviously, because I'm using some leverage, I always want to be careful of potential market declines. Now, if you're not actively trading, you're just doing long-term investing, really, this is the best situation to do dollar cost averaging. Dollar cost averaging works. You just keep buying over time. And in volatile situations, it's great because you're more likely than not to buy it at good prices. And most of the time the market's in a bull market anyway, so it's a good strategy. And the other alternative to protect yourself from a potential risk of a market decline is if you need to have certain parts of your assets that are not going to be impacted in terms of its value. You need the liquidity or you need that cash. It's just to put it in fixed income or bonds because those have less volatility. They're less likely to move up and down. So if you need to protect your investments for whatever needs that you have, just allocate some more into fixed income or bonds. And rates are higher right now, so you get a good yield. So it's honestly a good deal. So just to summarize, crash indicators, is the market going to crash 2025? So first thing, are we going into a business down cycle? I think it's unlikely based on both timing of bull and bear markets, suggests we're maybe mid-cycle, and just looking at, honestly, from the economic data that we're looking at, it doesn't look like we're entering a down cycle. If anything, it looks like we're having an improvement in the business cycle. Now, second thing is extreme valuations. Yes, we have high valuations, but it's not at extreme levels. And when we look at the actual earnings, I think it's not unsupported. I think that the valuations are supported by earnings growth. And what I do think will happen is even if these tech stocks are kind of overvalued, they'll come down. But I think the rest of the market, these non-big cap tech stocks, they might have better performance. Their valuations could come up. So basically, the market would probably just normalize and broaden out. Recession, financial crisis, we looked at a ton of economic data. I don't really see any signs of a recession coming, right? Unemployment and inflation are key risks to us. Basically, are there jobs being created and are prices going too high? As long as we have productivity and jobs growth, we're going to be good. And then from a speculation sentiment standpoint, we just looked at that. I don't see the signs of extreme bullishness that can reverse and create the kind of the seeds of a market crash of extreme buying. So I don't think it's there. I don't think it's time for a crash or even a change in market direction. Instead, what I think this year, you're going to see a broadening out of stocks. You don't need to buy expensive valuation stocks, but I would say keep buying these companies that are more reasonably valued, that are growth companies. And overall, keep an eye on the risks. We don't know what the market crash will be, what the risk for the next market crash will be. It always changes, but I wouldn't say this is by any means to stop investing. I think that this is still going to be a good year for the market. But that's all the data for now. And I'm going to put this all in a spreadsheet that you can download. There's a link in the description. Let me know what you're seeing in the data, and I will see you in the next video.
Oh my gosh, there's so much data.
So much data.